you are new to investing, some things you might want to keep your eye on. So number one, you have to keep your eye on the news and just keep an eye on the S&P 500, the Dow Jones Industrial, and what you want to look for is nothing specific, but you want to hear if experts are talking about all-time highs and records, because at the beginning of the year, that's all everybody was talking about was the S&P breaking records. And I'm not predicting a bear market, but before a bear market hits, before bears attack down, and that's what they are predicting the market is going to do. When the bear market hits, if it hits, generally and historically, it always comes after a period of highs, and the highs it doesn't go from 0 to 100 and then 100 to 0. What happens is you go through a period where the market is moving sideways, which we are kind of in right now. So that's why only reason why I'm giving you these warnings is because number one, if the market is moving sideways, you will see a period of lower highs and higher lows. So basically what it means is that the stock market will still go up high, but it'll fall further down. And then when it goes up, it'll go up for a brief period, and you won't hear a lot of talk about all-time stock highs. You will be hearing more about how far we are away from the highs. It's always in the stock market when everybody is happy, when everybody is enjoying themselves. That's the time where you need to start preparing for the decline. And to me, after all these years, I still don't know what's going to happen, but I just wanted you to keep your eye on how often the stock market reaches its high, because we may go into a period where we see a new high every month or a new high every week, but that might be rare. So I want you to keep your eye on the S&P 500, how often it reaches its new high. I want you to pay attention every time there's a decline, how far the stock market dips when it dips. Recently, last week, we've seen a whole lot of days where the stock market dipped 1%, almost 2%, somewhere in that 1% to 2% range. Just keep track of that, because if we have a day where the stock falls 5% in one day, that will be crazy. But a 1% dip isn't much to really be concerned about. You want to look over your portfolio, and when you hear that the S&P 500 has dropped so many points or so many percentages, and you just want to see, how was your portfolio affected on that day. So that's number two. Again, you want to keep an eye on how your portfolio is doing compared to the S&P 500 or the Dow, and that would really give you insight into how balanced your portfolio is, or how hard you're being hit compared to the market, and that's good for investors to know about. Three, you want to keep an eye on the IPOs and the specs. Generally, when everything is going well, there are a lot of IPOs, there are a lot of specs, and this isn't a criticism, and I'm not blaming anybody, but a lot of time when the market is doing really, really well, people are hungry, people are excited, they will buy anything. And those are the times where you see a whole lot of IPOs, a whole lot of specs coming out, a whole lot of new companies coming to market, because people are hungry and excited and want to invest. They're running out of things to, every stock is already at its all-time high, and people are really, really just antsy and want to put their money in something new. And that's the perfect time for these hedge funds and these investment banks to really just throw out crappy companies. And in a good market, crappy companies do just as well as bad companies. And a lot of times you don't realize if your company is good until after the bear market has set in. And like I said, I'm not warning. I don't think a bear market is coming, but I just want you to keep an eye on that, because everybody wants to say, you know, if you turn on the news right now, everybody is discussing, are we in a bear market, what to do in the bear market, and I'm just giving you the signs to figure it out. So again, keep an eye on your stock, keep an eye on the S&P 500, keep an eye on how many IPOs and new companies are coming to market. Keep an eye on mergers and acquisitions. We are in a time where there is no alternative. People have all of this money and they have nowhere to put it. So they're not going to put it in a savings account and not gain interest. They're not going to put it inside of a CD or a bond or anything else like that. Everybody is investing in the stock market right now, and that is the reason why stock valuations are so high. And the crazy thing about the stock market is, once everybody has brought and held, there's nobody to buy. And that's generally when stocks start moving sideways or start going down, because the stock price is really derived at like an auction. You have supply and you have demand. You have an ask and you have a bid. So when I buy stock, I'm buying it from another person. Unless it's a new IPO, every time you buy stock, you're buying it from somebody who's selling it. And what happens is, if you get too many people that want to buy and not enough people that are selling, the price that these brokers, that the stock brokerages are asking for the stock, that price goes higher and the stock price goes higher, because basically what the guy says, he said, I'm trying to sell this and I got 3 people asking me, all right, which one of you are going to pay me $25? All right, next time I get more stock, okay, you're going to give me $26. And the more demand it is, the higher the stocks go. But what happens when there's nobody asking the brokerage or, you know, the deal makers, the money men, to buy the stock, and you still have a few people selling? Now that ask price goes down and the sell price that they can sell it for goes down, because nobody's buying it. So they have to offer it at a discount of $1 or $2, $3. But then that's how the stock market goes up and down. And that's how we get the fluctuations. So you just want to be careful in situations where, for one, everybody's buying stock, because then you get supply side issues where the demand for the stock is driving the price. And then you have to be careful of when everybody is either selling, or when there aren't too many people interested in investing and people aren't asking to buy stocks. If everybody is scared of this bear market, then, or if everybody thinks that the stock price is too high, then there will be less demand, and people are going to say, no, I'm not going to buy that. I heard on TV that stock prices are too high, or I heard that, you know, whatever the rumor was, they're not buying the stock. And now the people who sell it, they say, oh man, all right, I'll take $1. I was selling it at 25, but I'll sell it for 24. And then as that happens, multiplied by millions and thousands of orders, the stock price slowly starts to go down. So you just got to be careful about that.